The first cryptocurrency, Bitcoin, was introduced in 2009. There are dozens of cryptocurrencies available now. With a market cap of over $2 trillion, tens of thousands of cryptocurrency billionaires were created this year thanks to the rise in their prices, at least on paper. Cryptocurrencies may wind up becoming a large speculative bubble that harms a lot of uninformed investors. With the current market drop, many Bitcoin fortunes have really already vanished. But regardless of how they turn out, the brilliant technology advancements that support them will change how money and finance work. Before we start our video, click that subscribe button to enjoy more of us. First myth: real money that can be used for transactions is a cryptocurrency. The idea behind cryptocurrencies like Bitcoin and Ethereum was to eliminate the need for checks, debit cards, credit cards, and other conventional payment methods. The Bitcoin white paper, which launched the cryptocurrency revolution, describes an electronic payment system that eliminates banks and governments from the financial system by enabling any two willing parties to interact directly with each other without the need for a trusted third party. According to the website Payments, which makes reference to the computational engine that powers cryptocurrencies, blockchain is the future of the payments industry. In actuality, using cryptocurrency to complete transactions has become extremely expensive and time-consuming. A Bitcoin transaction's validation takes roughly 10 minutes, and the recent average charge for only one transaction was around $20. The second largest cryptocurrency, Ethereum, handles transactions a little bit quicker but charges exorbitant fees. Additionally, the value fluctuations of the majority of cryptocurrencies render them untrustworthy as a form of payment. The cost of a Dogecoin was 20 cents as of late April. In the following 2 weeks, it tripled, and 10 days later, it dropped to half of its high value. It's as if a $10 bill could be used to pay for a luxurious lunch at a high-end restaurant a few weeks after purchasing simply a cup of coffee one day. A big cryptocurrency's value, like as Ethereum, may change by 10% or more even on a calmer, more average day, making it too unpredictable to be useful. Tesla recently stated that it would stop accepting Bitcoin as a form of payment, reversing a policy it had put in place earlier in the year. According to Elon Musk, a single coin's worth decreased nearly immediately. After that, a temporary crackdown on cryptocurrencies in China temporarily reduced the price by another third in just one day. Second myth: investment wise. Cryptocurrencies are wise. Bitcoin and other cryptocurrency investment funds are widely available. Even big banks like Morgan Stanley and Goldman Sachs are joining the fray. And if you had purchased any of the main cryptocurrencies last year, you would have undoubtedly earned a spectacular return. A typical Motley Fool article discusses whether one is right for you, rather than whether cryptocurrencies are a solid investment. According to the website Business Mole, Bitcoin and Ethereum are still quite profitable even after changes. It is easy, but take care. The fact that the supply of most cryptocurrencies is carefully limited, like that of gold, appears to be part of their appeal by the computer programs that manage them. As an illustration, around 18.5 million Bitcoin have been produced so far, and a maximum of 21 million Bitcoin will ever exist. The computer software that controls the currency's supply has set this limit. Demand must exist in order to create value, though scarcity on its own cannot. Cryptocurrencies only have value because many people appear to believe they are good investments, despite the fact that most payments cannot be made with them simply and that they have no other inherent uses. If that happened, their worth might suddenly vanish. Before we continue, subscribe to us now. Third myth: Bitcoin is losing value. The future belongs to meme coins. Investors, or speculators, to be more accurate, are pouring money into other cryptocurrencies like Dogecoin because Bitcoin is now seen as the grandfather of cryptocurrencies. Bitcoin was allegedly losing its strength as the driving force of the cryptocurrency market in 2019, according to Investopedia. According to a recent Forbes headline, Bitcoin and Ethereum are being left in the dust by Dogecoin. Dogecoin and similar cryptocurrencies don't even pretend to be able to be used for financial transactions because they are purely based on memes. Dogecoin, with its Shiba Inu dog mascot, recalls the Doge meme. The quantity of these currencies is also not clearly constrained, thus their prices might fluctuate wildly in response to unpredicted events like tweets from Elon Musk. Mean currency prices appear to be totally predicated on the greater fool principle, which states that all it takes to profit from an investment is to locate a greater fool who is prepared to pay more than you did for the digital coins, compared to some of the more recent cryptocurrencies, which provide greater user anonymity, quicker transaction processing, and more advanced technical capabilities that facilitate automatic processing of intricate financial transactions. Bitcoin's technology does appear to be out of date. But despite all of its shortcomings, Bitcoin continues to rule. It is responsible for almost half of the value of all cryptocurrencies. Fourth myth: the dollar will be displaced by cryptocurrencies. Ruchir Sharma, the head of global strategy at Morgan Stanley, has suggested that Bitcoin poses a substantial challenge to the greenback's supremacy, or at the very least that it may end the dollar's reign. Even more menacingly, a Financial Times headline claims that Bitcoin's ascent symbolizes America's downfall. The only thing that supports cryptocurrencies is the belief of the people who hold them. The U.S. government, in contrast, backs the dollar. Even in difficult circumstances, investors remain confident in the dollar. As an example, even with low interest rates, domestic and international investors continue to avidly buy trillions of dollars worth of U.S. Treasury securities, stablecoins, a new class of cryptocurrencies, seek to have steady values and so simplify the process of making electronic payments. Facebook intends to launch DM, a cryptocurrency with a steady value that will be backed one for one by dollars. However, stablecoins' value comes from the fact that they are backed by legally recognized money. The dominance of the U.S. dollar as a store of value will therefore not be under jeopardy, even though dollars may become less significant in making payments. Fifth myth: cryptocurrencies are merely a trend that will pass. Cryptocurrencies have been compared by Warren Buffett to the Dutch tulip fad of the 17th century, and Bank of England Governor Andrew Bailey has advised, buy them only if you're prepared to lose all your money. The economist Nouriel Roubini even slammed Bitcoin's fundamental technology, calling it the mother or father of all scams. The future of cryptocurrencies as speculative investment vehicles is uncertain, but they are already changing the way that people think about money and finance. Stablecoins will hasten the rise of digital payments as technology develops, ushering in the end of paper money. Central banks all over the world have been compelled to create digital copies of their currencies due to the threat of competition from such private currencies. While nations like China, Japan, and Sweden are testing their own national digital currencies, the Bahamas has already launched its own central bank digital currency. If you still have any dollar bills in your wallet, they might soon become antiquities. Even financial transactions like buying a vehicle or a house might be handled by computer programs running on Bitcoin infrastructure. Digital tokens that represent money and other assets might make it easier to conduct electronic transfers of assets and payments, which frequently take place without the involvement of reliable third parties like real estate settlement attorneys. Governments will still be required to uphold legal agreements and property rights, but software may eventually replace traditional middlemen like bankers, accountants, and attorneys. So, did you enjoy watching our video? If you want to learn more about cryptocurrency, subscribe to us now.